Well, let's start to work some problems now about in the first three learning objectives. The first three learning objectives have to do with initially recording, and we call that recognition. So we're going to recognize that we have a non-current liability, which means, of course, we're going to credit a non-current liability. And the question here has to do with how we do the journal entries and what accounts we use when we do the journal entries. But important here is the amount at which we record our liabilities. In our previous chapter, we found that generally we are going to record current liabilities at the maturity value. That is to say, the amount we expect to be paying back in the future. In contrast, in this chapter, we start thinking along the lines of the theory of accounting, which tells us that our liabilities, that our financial instruments, should be recorded at the present value of cash flows. The theory tells us that we should have been doing that also in the previous chapter, the previous module, when we were talking about current liabilities. And the reason why we didn't do it in the previous chapter is that the difference in the value of something, taking its present value or its future value, is very little when we have short time periods. As we increase the time period, then there becomes a material difference between present values and future values. So we took a shortcut in chapter 13. Theoretically, it's not proper for us to have done that. However, in practicality, there's so little difference, we do it. In chapter 14, however, the term of these liabilities can be quite long, and therefore we need to do present value calculations. As we will prove when we work through the module completely, if the stated interest rate and the market rate are the same, then our present value calculation will get us to the same thing as maturity value, and therefore we don't have to do it. The problem in the non-current liabilities that causes us to have more complexity in the way we do our initial journal entry has to do with the difference between the stated and the market interest rates. So if there's a material difference between your stated and your market interest rates, you're going to have to do something different. And that is on 2 in Learning Objective 2, which is the concepts of premiums and discounts. And the reason why they arise is that difference between the stated rate and the market rate. And then we also need to discuss, of course, here a little more what are our definitions of, and what is the stated rate and what is the market rate, and how that affects us. So we will go through 1 through 3, and then the next voiceover or problems will address the other learning objectives. So you'll be reviewing and listening to the lecture on those topics, and then we'll go back and we'll work some more problems. Having a little difficulty scrolling down here, so my apologies. So under the next page on understanding debt interest instruments, we are also talking about financial instruments or financial liabilities. All of these should have interest and a principal component. And as we did in the previous module, we recognize that at times we have a discount, and at times we have things that do not bear interest. And when they don't bear interest, it's unreasonable to assume anything would not have interest. and therefore we need to kind of come up with a value of that interest, and we put that interest in our discount. So we're continuing along those lines. For notes payable, they have a stated interest on the face of the note. And if you'll recall from your previous classes in other semesters, either the note is going to say a percentage of interest, or it's going to state how much interest is going to be paid. And that's how interest shows up. And when we talk about stated interest, that's what we're talking about. It's stated because it's contractual. Okay, it's a statement. Think of it that way. That's the easy way to think of what stated means. And bonds, they have a stated interest rate, and again, it's a contractual rate. And so either one of these, we're going to use the term stated. Usually when we talk about notes payable, we say reasonable rates. Instead of saying market rates, we say what is a reasonable rate. When we talk about bonds, we can say the market rate. And we can use that expression because there is a market, a traded market for bonds. And I'm sure in your finance classes you learned about that. And you learned about the pricing of these investments in bonds and how that the pricing changes with interest rate changes. So you had kind of a heads up that there's something going on there. With the corporation, though, once we initially recognize the bond payable, put it in our books, then we don't pay any attention to what happens to interest rates after that point in time. So when we talk about market rates, we're talking about the market rate at the time when we put the bonds on our books. That's the only reason we are concerned about those rates. We don't adjust anything for changes in market rates once it's recorded. So just so you understand, there are similarities in what we're doing and what you learned in finance. There are also differences. So we are going to go down here. I'm trying to get my scrolling to work here, and it's not working the way I would like for it to work. So bear with me. Here we have an example, and instead of China Palace here, instead of China Palace getting cash in for a note, they are going to get an automobile. So the financing is being provided by the supplier of the automobile. This is a typical situation that exists, and you have to understand it doesn't always have to be a bank that's supplying the funding. So here they're buying an automobile. And in terms of accounting and accounting theory, it really doesn't matter if we are talking about going to a bank or the financing from another source. It shouldn't affect how we record things. So here, instead of doing a debit to cash, you're going to be doing a debit to an automobile. And the total amount of the payment that's going to be repaid is $10,000, but there is no interest. And the stated interest then would be zero. And in this situation, I'm going to use again market and reasonable as interchangeable. So I would say market rate in this case is 8% because that's the reasonable rate at which China Palace, given their riskiness, would be able to borrow funds. We're back to the concept of what we had in the previous chapter. It's just illogical that anyone would do that. So we ask the questions, what is the proper, and another way of saying that is the market rate for the note, and that would be 8%. The second thing to do is say, how does that 8% compare to what is stated on the note? And the statement on the note is really to say that there is no interest. There's no interest. So the way that the interest rate compares then is to say that there is no interest on the note. So of course the market rate exceeds the stated rate. And in this case, anytime market exceeds stated, anytime market is not equal to stated, I'll say it that way, you have to do a present value calculation. So you have to do that. In step 3, we want to figure out what this present value is. You have to go in and you have to say, what are the cash flows? In some problems, you will have an interest cash flow because they will be paying interest. When stated and market don't agree, there's still some interest paid. That's the next example. In this one, there is no cash flow from interest payments. There is only the cash flow at the very end, which is paying it off. The payment that is made is going to be $10,000, also maturity value. We need to take the present value calculation of that. Although I have this set up so it's first the 0.6805, which is a PV of 1, 5 periods of time, always use market rate when you do this calculation. This is always market. Although I have it set up so that you see the PV in the first area and then followed by multiplying by the cash flow, it's probably easier if you set up a table and you have in your first column your cash flows, in the second column your present value calculations, and then you multiply it across, and you're going to see that coming up. So in this case, the present value of the amount which is borrowed is $6,805.80. The difference between the present value and the future value is interest. So the interest or the financing is $3,194.20. So the value of the automobile, which would be the same as the value of the cash coming in, if that would have been the way that the transaction was structured, is going to be only equal to $6,805.80. The value of the automobile is not $10,000 because a part of the $10,000 that's going to be repaid really is interest. So it affects how the automobile goes on the books, but it also affects how you record the liability. So now we're going to start on a table. And here again is the definition of building the table. It says, what is the automobile? 6805. What is the financing? 3194. What is the amount that is really paid at the end? 10,000. So when we do our table, I set up the table in this format. And the first column is the period. There are 5 annual periods here. And it's very important when you work through these problems that you recognize how often the interest is paid or how the terms of it are. And in this particular instance, there is no discussion of the semi-annual, annual, quarterly, because there are no payments of any kind being made. There's no interest being made. The only payment that comes is at the end. And we have a problem like this. You're going to assume that the periods are annual periods and that there are 5 of them. And at the very end, as you see, there's not a number 6 here after the number 5. This is done actually at the same time as 5. You are going to be removing the $10,000 liability. Now, the first period of time I often use and put in there a 0 because this tells us that this is the time when we put the liability on the books. So when we put the liability on the books, the carrying value of that liability is going to be same as the value of the automobile, which is $6,805.80. We also have to keep track of what I'm calling here principal. In the case of bonds, we call that face value. And then in this case, because the total, when we did our present value calculation, is less than the amount that's going to be paid back in the future, we say we have a discount. Because when we do our present value calculation, That is also the initial carrying value. So we have an initial carrying value which starts out at 6805.80, and what do we want to do? We want to continue that so that the carrying value at the end is 10,000. Said another way, we want to make sure that our discount becomes 0 at the very end. And if you'll see here in this, at the end of period 5, the way we do this to remove the discount, we actually have 5 cents left. Why do we have 5 cents left? Well, we have the 5 cents left because we are using the effective interest method, which says we need to use present values. And our present values, if we're using our tables, only go out 4 digits. If you're using your calculator, it's quite possible that you do not have the 5 cents left. Whether you use your calculator or whether you use the tables, there's not going to be a material difference, and if you're 5 cents off, it really doesn't matter. What we will do, and we'll show when we do the journal entries, is we'll just get rid of an additional 5 cents, or we will reduce our last journal entry there for period 5 by 5 cents. We'll do something so that in the end the discount has a 0 balance. Let's talk about where the numbers are coming from the table. It's very important you understand this. In the first period, in the period column, I should say, the first column, you need to start labeling it and going from 0 up to 5, and 0, the first line, is going to be when you put it on the books. And of course you establish then the value, the starting point for working through the table with that first line. In period 1, if you paid interest, you would put the interest amount, the amount of interest you pay, right there. In this case, we don't pay any interest because it's stated that it's a non-interest bearing on that particular note. Interest expense. This is one of those things that's just so important. If I were with you face to face, I would keep saying it over and over and over again. And I would go around the room and I would say, okay, what is interest expense? Tell me the formula, because it's an algebraic formula. Interest expense is always carrying value at the beginning of the period times the market rate. Okay? Carrying value at the beginning of the period times the market rate. Okay, so we look at this and we look above, and you can see at the very top I have PV of 1 and I'm saying 5 periods of time and I have 8%. When we make our present value calculations, we always use market rate in there. So I don't even have to go up to the very top of the problem and say, what is the market rate or the reasonable rate? I can just look at this and tell you it's 8%. So 8% of 6805.80 should get you the $544.46. Again, you may have some rounding there, and it may not come out exactly 46 cents, right? So that's perfectly fine. Round up if you want, or in some instances I've even seen people use problems where they don't even have cents in the problems. They round to the next dollar. And what I do in the tables, I'm going to round up in cents. All right, that 544.46 cents, as we learned in our chapter on current liabilities, that 544.46 is generally comprised of 2 components then. It is comprised of the actual amount of cash which is being paid in interest expense, and it is also comprised of the amortization of discount or premium. So interest expense is coming from 2 factors. It's coming from cash interest, and it's coming from amortization of discount or premium. In this case, we have no cash payment. Therefore, our cash interest expense is zero. All of this interest expense is coming from the amortization of the discount, which means we are taking away the discount. We are reducing the discount. And how much do we reduce the discount by at the end when we do our journal entry to amortize it at the first period? It is 544.46. How did we calculate? Carrying value times market rate. Now, after we do that, after we take this 544.46 off of here, then you see what we started with 319420 becomes 264974. This is a recursive sort of a table. You do it in Excel if you like, and you build it. And so you start here at the very starting point here, you start putting in formulas, and you put in a formula which says that this carrying value is going to go up because remember a discount reduces carrying value and you're reducing what reduces it. So if you take away the thing that's being subtracted, in the end you end up with just the 10,000. And that's the whole concept you want to use. I'll take a moment now to say why it's called effective interest. It's called effective interest because a reader of the financial statements would take interest expense as a numerator, and on the denominator they would take the amount of liability, and they would say, what is the rate of interest this company is paying? And a reader of the financial statements would take interest expense and put it on top of the liability to calculate it. Now that is not the interest that is actually going out as terms of cash flow, but it is in effect the amount of the interest that the corporation has paid, because remember what happens if the interest is not reasonable. In this case, there is zero interest. When there is zero interest, what happens is that the amount of cash which would come in is going to be reduced. They're going to take their interest cut from the beginning. So that is really the interest rate that the company is paying. It's factored in such a way, even though the document says zero, actually what's happening is they are paying 8%. So we want the financials to show they're paying 8%. And that's the theory. That's the reason why we have to use the effective interest method and go through all of this and build this table. Now, notice that interest expense changes. Interest expense is going up. Why is interest expense going up? Interest expense is going up because we know interest expense is carrying value at the beginning of that time period times the market rate. Carrying value changes. In this instance, it was at a discount, which means our carrying value is going to be increasing up to the amount that's going to be repaid, or the 10,000. So if carrying value is going up, interest expense is also going up. And again, what's happening here then in the financials from a financial perspective is that the relationship between interest expense and beginning of period carrying value is always going to be, it's always going to be a calculation of 8%. And you know, it's an algebra thing. I find a lot of my students, if I ask them that are studying accounting, I ask them, did you like algebra? And more often than not, they tell me they loved algebra when they were in high school. And accounting has a lot of algebra in it. And this is just an algebra formula that you have to memorize. And again, if you know Excel, it's very helpful. You can build a table. Don't worry about the 5 cents. We have another one here. This gets a little more complicated. So here we have them buying it. In this case, though, the only thing difference between this and the other problem is a special promotion and the interest rate is 2%. So 2%. So in this case, we're going to have another cash flow, and the cash flow is the interest that they're going to pay. How much interest are they going to pay at the end of every year? At the end of every year, they're going to pay 2%, and 2% of 10,000 is going to be $200. So you're going to have to do a present value calculation of the 200. The 200 is going to come in equal amounts, equal distant apart. So it sounds like an annuity. It is an annuity. So you will use the present value tables for annuities for this one, and we'll do it as an ordinary annuity. The reason why you'd use ordinary and not due is because interest always follows a period of time. If there's no passage of time, there's no interest. That's just the way interest is. There has to be a passage of time. So we call this an ordinary annuity. Regardless of all of this complexity, let's go back to the basics, which say talk about it in steps. What is the proper reasonable market interest rate? Again, it's still 8%. What is the amount that is stated on it, and how does it compare to that? The stated is 2%. So the person who sees this is going to say, my, this is a great deal. I pay 2% when if I went to the bank and borrowed, I would pay 8%. But in actuality, it really isn't a good deal because the seller of the automobile has already factored into the price of the automobile the fact that they are not collecting interest from you. So they've already done that. They've in effect raised the price on you. So when you do your journal entry, then you need to not show that automobile at the full amount of 10,000, but you're going to show it at something less. Let us look at the present value calculations. As I said before, it's really theoretically better if you put the cash flow first, then the present value amount, then multiply across. So if I were putting this more of a table or a setup sort of a thing, I should put the 200 first, then the present value, which is 3.99271. I think that looks a little cleaner. Okay, but notice the reason why I set up like this is I wanted you to compare these two PV calculations. Both of these use the same period. And period, remember, is the row in your table. And both of these use the same column. And the column is 8%. 8%, is that the stated rate or is that the market rate? I hope you said market, because we always use market in here, always market. Now, although this is the same in this and this, the value, this being 0.68 and this being 3.99, these are different numbers. They're different numbers because they came from the two different tables. And when you have an annuity, here's a little trick I have. Sometimes we get confused. Sometimes we put the 3.99 up here instead of the 0.68. What's the trick? The trick is generally PV of 1, except for the first line in a table, is going to be less than 1. And generally when we look at an annuity, annuity values are going to be greater than 1. And they are really pretty close to the number of periods. So if I look at this, I'm going to say this is close to 4 and that's 5. So it's close, right? All right, so calculating across, you're going to have to add the two together to come up with the value of this automobile. In our other problems, we would have said that's the amount of cash that you get in. But in this instance, we are going to be saying that that is the total amount for the automobile. So the financing in this instance, you know, I sorry about that, but the amount of financing in the calculation is really the difference between the 680580 plus uh, uh, 680580 plus 798.54. So pardon me for having an error, but the total amount for the automobile should be those two combined. So it's not 680580. There's an error there. My apologies. But how much is the financing? The financing is the difference between those two amounts combined and the 10,000. How much is the cash interest that will be paid over the total of the 5 years? It's going to be $200 each time, or $1,000. And the total amount then that ends up being paid is 11,000. They're going to be paying actually 10,000 for the amount at the end, which again, part of it is financing charges, and they are going to pay $1,000 in interest. When we look at our table, the table is going to show then that table is going to show then the initial carrying value, and this is different from the initial carrying value in our previous problem, because in this we are going to add this and this together to come up with our carrying value. Now the principal is the $10,000, and the difference between the 10,000 and the carrying value means that we have a discount. We know we have a discount also because we have to say, is the stated adequate? Stated is not adequate. This table is built very similar to the way we built the other table. Interest expense is always carrying value at the beginning of a period times market rate. Again, market rate is 8%. We can see that also by looking up here. Notice we use the same percentage, same period for these. We can see it's 8%. 8% times this gets us this. So this does not change. This is just something you need to memorize. Interest expense formula is always that. When we get the 680535, recording that as interest expense, when we have payments of $200 which are made, then we recognize, as we did when we were looking at it in the current liabilities chapter module, that now we have interest expense comprised again of two parts. One part is amortization of discount, the other part is the cash payment. How do you figure out how much is amortization? Well, your journal entry, when we get to those, will be interest expense debited, and it will be cash credited. And if you have interest expense debited and you have cash credited, you recognize your journal entry is off by $408.35. Therefore, the $408.35 is the amortization of the discount. Just like the other problem, we are going to build our table, which is going to show the discount being reduced as we go along, which means the carrying value is going to be increasing. And at the very end, we see we're off by 5 cents, but not to worry. When we do our last journal entry, we will fix our problem. This is still the effective interest method, which means interest expense is again proportionate to the liability, which means the reader is going to read it and say they're paying 8%. We have another one here, and it is where we have market rate equal to the stated rate. Well, we don't have a premium or discount with this one, and we can go through the calculation and show that. The proper is 10, the stated is 10, it's the same. The amount of the principal is going to be the 10 million. There is no amount of implicit or implied interest because the total amount is only going to be the 10% we're paying. And 10% of 10 million is going to be 1 million. So as we build the table, I wanted to build this table for a reason. The reason I want to build the table is I want you to understand that thing that's so important that you understand, which is that interest expense is carrying value times market. It still applies for this. In this problem, interest expense is coming completely from the cash component and not the amortization component. So we had a problem earlier where interest expense was coming in its entirety from the amortization of discount. In this problem, the interest expense is coming entirely from the cash component. So that thing we learned, it still holds, but we don't have to do it. We don't have to do it. And so this is a simplified version of life that you learned in Accounting 201, where there's no discount, no premium. There's no need to amortize. So this is just showing you that we could do it this way and it would work for us. Now we have another example I want to run through, and this is by far the most complex one because in this one we have stated at 10% and market is 8%. So in this case, an investor would just think this is wonderful because the amount of return is 10% versus 8% that everyone else is paying. So the way to think about this is the investor is going to find this highly desirable and they will be willing to pay more for it, which means that the company gets more money in. But again, the same thing prevails in that the company is actually going to be paying the market rate because what gets adjusted is the amount of cash that's flowing in at the beginning. And there's actually going to be more cash coming in to the company in the beginning here. And the difference is going to be coming from the fact that there's a differential between the 8 and the 10%. We have to do the present value calculations, and there's so many things that you do in exactly the same way throughout the problems, and I call this the setup. It's just a thing to memorize, a thing to do. And in the first column you typically put cash flow. In the second column you do present value calculations. You have two present value calculations, one for the amount that gets paid at the end and the other one for interest. If you had no interest being paid, then you could put a 0 here, right? In which case you'd have 0 over there, and you could say the present value of that thing would only be the 6.8 or so $million. So it's the same setup, except in this case, when you do the setup and you add down, you find that the number, which is the way it should be, is going to be greater than the face value. And that is exactly what we would hope to see because we wanted to have a premium. And if there's a premium, by definition, then carrying value exceeds the face value. So again, adding these two together, we come up with a number that is greater than 10 million, which is proper. We have to ask ourselves, is there interest being paid and how much is the interest being paid? And this interest is going to be 10% of 10 million or 1 million. So we start now and we begin to build our table. We have to do all of these steps and just to get us to the point where we can create the table. And so we don't stop at this point. We go on forth. We go forth with it. And when we present this, by the way, we are going to show these as 2 credits, which will increase our credit and increase our carrying value from 10 million to 10,798,510. So when we do our table, then again, we are basically replicating the same standard table we've been doing. The only difference here is previously we reduced the carrying value by the amount of discount. In this column, you see we've replaced the word discount with premium. So the carrying value is the amount, which is the principal, plus the premium in this instance. And as it shows up on the financial statement, the word carrying value is coming from your financial statements. It is the expression, what is that liability carried at on the financial statements? And so carrying value is an expression that's related to that. What is it carried at on the financial statements initially? And this would be period 0. So if you want to write in your documents and start and say 0, that means the period of time which you actually put this bond on your books. You would record it at 10,798,510, but the two accounts, instead of principal, that would be called bond payable, and the premium would be premium on bond payable. Two amounts would be equal to the cash debit of 10,798,510. You're getting more cash in than you're actually repaying at the end. The next one is then payment for period 1. At period 1, we are going to have a cash payment, which is the interest which is owed. And the interest in period 1 is going to be $1 million in cash. What is interest expense? Well, wonderful. Wonderful that we don't have to come up with a new formula. It goes back to our standard algebraic formula, which is initial carrying value at the beginning of the period times the market rate. That is equal to interest expense. And so with this, like with a discount, interest expense is going to be proportionate to beginning carrying value. And I'd say, what is that fraction going to be? And you probably don't even have to make a calculation. We don't have to put 863,881 divided by 10,798,510 because we know from algebra it's going to be 8%. Okay? So any of these numbers that we compare, this to this or the next line up to that line, it's always going to be 8%, because that is by definition what we have when we have the effective interest method. The other thing you learned in the discount example is that we don't have to go back and look at the problem. We can look up there at the present value and see the present value is using 8%. Therefore, we need to use 8%. I want to look at this table a little bit more because I want to show you something else that's happening with the table. My apologies, there's some little glitch here. It doesn't always scroll right. What we see here is that carrying value at the end, just like with the discount, carrying value needs to be face value, and that's a term in with the bonds. It needs to be face value. So I would like in period 5 for this number here to be 10 million. That's what I want to see. That means my premium needs to be 0 right here. Because we are using, in this instance, the present value tables that only go out so many digits, we have $47. And some students are upset, oh, there's 47, it's not right. And I have to say, it is right. It's a matter of materiality. Do you suppose $47 really matters when the bond is worth 10 million? Do you think it's material? And the answer is no. You divide 47 as a numerator and 10 million as a denominator, and tell me how many zeros there are, right? It doesn't matter. The only thing that's going to matter, and we will discuss, is that you're going to have to adjust your journal entry when you do it in the last time period, and you adjust interest expense a little bit, you adjust the amortization amount a little bit, so that the premium is completely removed from the books. I want to say again, this premium amortization is related to carrying value. Initial carrying value is initially above the face value, and it goes down So if carrying value goes down, then we see what is happening is that the amortization is going to change with the value of the carrying value. So this happens within our table. All right. So interest expense is going down because carrying value is going down when you have a premium. Now, this is not straight line. I just want to bring to your attention yet again, it is not straight line. What we did in our previous chapter when we had interest expense as we recorded it straight line. We took the interest amortization, the total amount that needed to go away, we did it and we allocated it according to time periods. If we used the straight line method, we would be taking this premium of $798,510, we would divide it by 5, and we would record the amortization part of interest expense in the same amounts in this column. We're not doing that, are we? And so one of the rules that you're going to get into and we'll discuss is that if there is not much difference when you build this table between this number and this number, then you can get away with taking this number and dividing it by the periods and just doing it that way. That is okay, as long as there is not a material difference. However, when you take the CPA exam, they're going to ask you what's the amount of amortization. They're going to ask you what's the amount of total interest expense. And you're going to need to know how to do this table, how to create this table. You're going to have to recreate the table. Now, another thing I wanted to discuss with you is this notion that interest expense is not cash payment. The only time interest expense is cash payment is when you have no amortization of premium or discount. And that only happens when stated is equal to market, or when your non-current amount, when your liability is only of a current nature. It's not non-current. Here we have another problem here that you can work through, which has bonds. And bonds, pardon me. And the bonds in this instance are those that have a stated rate of 6% and a market of 8%. And you can work through this problem and we come up with a total amount of 9,201,426. The cash interest is going to be paid is going to be the 600,000, which is the stated, times the amount, which is the face value of those. We work through the problem, we build the problem, and you should work through and see if you can recreate this. Now, after that, so we've finished up this section. You should go through, you should see if you can rebuild the tables, and if you come up close to my numbers, that's fine. The main thing is when you get down to the final line, you want to have a number which represents the face value or close to it. And if your numbers are a little bit different than mine, again, not to worry. You've done it properly. Whenever you are questioned about this on exams or on homework, you have some flexibility. So if your numbers aren't precisely the same, you're going to be just fine. Notice then when we go on to this page, which is I believe up to page 8 of this particular section, your numbers being different in the packet, it looks the same as where we started. And so what we're going to do when we start in our next section is we are going to start with what we did in the past, and we are now going to do the journal entries. So the first bit was in recognizing it, figuring out if we have a premium, if we have a discount, discussing what stated interest is and where it comes from, discussing the market and how when we have stated and market different, what happens? Does it create premiums? Does it create discounts? And then I gave you an introduction as in creating those tables so that you would have better understanding when we start on this next section. So after this, you should be able to work through anything in Connect except the quiz. You will be able to work through your Learn Smart area. And you should also have an understanding of learning objectives 1 through 3.